Capital Trust Holdings evolved into a diversified conglomerate with 25 subsidiaries. Capital Trust Securities has over 65,000 clients. The turnover clocked in financial year 21-22 is the all-time record by any stockbroking firm in the history of the Colombo Stock Exchange. Capital Trust Holdings has come a long way, starting off as a stockbroking firm. Knowing the economical, political, and security risks, it has evolved into a diversified conglomerate with 25 subsidiaries. Capital Trust Holdings is also expanded into wealth management, margin trading, corporate finance, and corporate finance we mostly do foreign assignments. Then we also diversified into property investments, and property broking, and Capital Trust Properties works actively with renowned global real estate giants such as Knight Frank, CBRE, Colliers, Sotheby's, as well as the local large apartment developers, as well as the local large commercial space owners. Capital Trust Group of companies has developed 3 apartment complexes, and they are elegantly designed and world-class standards. Therefore, it won 8 Property Guru awards in Singapore and Sri Lanka. The group also owns several large lands in strategic locations, and now we are renting out about 36 apartments which we own, and we are also renting out more than 100,000 square feet of office space. For the last 27 years, we are also running Shakti Institute, which is a leader in English medium support education, and also we are running ALFT Packaging, which is a leader in flexible packaging. Capital Trust Securities has over 65,000 clients. The turnover clocked in financial year 21-22 is the all-time record by any stockbroking firm in the history of the Colombo Stock Exchange. We worked hard for this, and finally all investors and all brokers benefited during this period, financial year 21-22. On another note, I must say that in the last 20 years, Capital Trust Securities, present and past shareholders and staff have been also credited for executing the largest number of strategic transactions in the Colombo Stock Exchange. It has undoubtedly been a highly challenging economic environment over the last few years. There has been a string of events which shook the economy and the investing landscape. The Easter Sunday bomb attacks. Then we had the unexpected lockdowns because of COVID. Then we had the sudden announcement of bankruptcy of the country. All these events, no one could have ever predicted or forecasted. We had the continuous depreciation of the LKR, and the only way to effectively hedge the LKR depreciation at that time was to buy stocks with dollar income and dollar assets. Then we had inflation close to 70%. And the only way to hedge against it was to invest in apartments and other real estate. This was considered the most prudent at that time under those circumstances. Each company had a budgeted revenue and a budgeted interest cost. No one expected the interest cost to go 3 times more. Now the real problem is that the financial institutions have been keeping the prime lending rate high the last few months, and this is against the wishes of the central bank. The credit to the private sector has come down by a staggering 221 billion from January 2023 to October 2023. Therefore, the biggest problem is that the improving economic conditions, the financial institutions are not quick in relending what they collected. So this is delaying the recovery of the stock market and the economy. We see a lack of liquidity in the stock market, which is the biggest problem affecting all investors at the moment, the last few months. So the reason is that the abnormally high interest rates prevailed in the last 1.5 years. Then we saw a flight of funds from the stock market to treasury bills and to fixed deposits. However, the financial institutions have been slow in reducing interest rates when the central bank has been monetary easing. It has cut policy rates by 650 basis points. The bigger problem is that the financial institutions are not re-lending, so there is a sort of a shortfall of funds in the system. However, now we believe that things have really turned around. The rapid decline in interest rates in the 3-month treasury bill rates, if you look, it's about 14.5%. If an investor, takes its taxable income of more than, if an investor has a taxable income of more than 3.7 million and subject to paying 36% interest, then what happens is the interest earnings you get from fixed deposits, it's 6.5%. Then if you look at even a lot of money went for bond trading, but now astute investors would say that it's too risky to enter now, and it's sort of, the game is gradually finishing. If you take Capital Trust Research, they did 32 webinars during the period 21-22. Then Capital Trust Research has been deliberately being silent in the recent few months due to many unpredictable variables going on. So these unpredictable variables I would name as the taxation policies, lending rates, geopolitics, and many other factors. However, Capital Trust Group has an array of services which we are able to offer our clients and become a one-stop shop solution for investments in diversified across many asset classes. In my opinion, the two areas which are likely to do very well will be stocks and real estate. We expect both the quantum of investment and the number of investors increasing into both these asset classes. This is especially because fixed deposits and treasury bill investments expected to mature soon, because people don't realize is most of the people have invested. I would say even up to about 90% have invested in periods less than 12 months. So therefore these will get matured, and then they'll suddenly see what they can get in the future is much less, and they will also calculate the after-tax return from fixed deposits, and they'll find it is less than 5%. With the IMF program in place, and the country has been able to introduce a wave of structural reforms, the government has embarked on a number of revenue raising and efficiency enhancing initiatives, such as the privatization of state-owned business undertakings with a view of achieving certain strategic targets. Then the conformity with the IMF program enables the country to obtain funding from IMF, World Bank, ADB, and if you really look in December 2023 alone, approximately 780 million was approved. And this is important, that this has created a framework for proper governance. And Sri Lanka's economic recovery is very conspicuous. The GDP growth has largely been negative during 2023. However, we expect it to be a positive 1.8% or more in 2024. What is spectacular is that inflation has fallen from a high of nearly 70% in September 2022 to 3.4% in November 2023. There has been a central bank doing monetary easing. There has been a total rate cuts of about 650 basis points in 2023. The 12-month treasury bill rate, which was 30.5, has come down to slightly below 13 now. If you take the fixed deposit rates, they have fallen even sharply. Then the average weighted prime lending rate also consequently from a peak of 29.6 in November 22 has come to a mere 12% now. So we can do business now. Then if you take both listed and unlisted companies, will considerably benefit from the decline in borrowing costs and expected to result in a notable recovery in corporate margins and profitability. Also, if you look at another way, now you get taxed at 36%. Individuals get taxed at 36% when you earn over 3.7 million rupees. So you end up with actually less than 7% from fixed deposits from banks after tax. And I believe more and more people will now consider investing in the stock market, which has no capital gains tax. Lower mortgage rates also is likely to increase people taking mortgages and investing in apartments and other types of real estate. Then other positive things are tourism earnings have gone up to 1.8 billion US dollars. Then worker remittances have gone to 5.4 billion US dollars. Official reserves are now at 3.6 billion. And there is a marked difference from what we saw 1 year ago. We expect private sector large foreign investments to come in when there is a stable government by end of 2024.